Hello friends, we are going to continue with redemption of debentures that we started in the last lecture, right? This is a very important topic related to debentures, redemption of debentures. So in the last lecture, we discussed about the very basics of redemption. What we discussed, let us quickly see. We said the issue of debentures means raising money from the public in the form of loan. This we discussed in the last chapter also in the issue of debentures, that what is debentures? It is taking money from the public in the form of a loan. On this money we will have to pay interest to the debenture holders. Like we pay interest on loan from bank, similarly we will have to pay interest to debenture holders, right? Then we said that these debentures are issued for a specified period. That is, after a specified period, money is to be returned to the public. Right? So, debentures are issued for a specified period. This return of money is known as redemption of debentures. When you have to pay back the money to the public, that is known as redemption of debentures. In most of the cases, the time of redemption and the amount of redemption are pre-decided. Right? Clear? So this is the very basics of redemption of debentures that we discussed in the last lecture. Right? Now, to this I would like to add two more things before we move on to a very important topic of debenture redemption reserve. Right? What are the 2 points here that I want to make? One is payment to debenture holders is an obligation of a company. Now, what does this mean? Payment to debenture holders is an obligation of the company. It means that you have to make payment to the debenture holders whether you are earning profits or not. Remember in the chapter of issue of debentures also, while we were discussing about interest on debentures, there also I told you that interest on debentures is a charge against profit. What do you mean by charge against profit? You have to pay that interest whether you are earning profits or not. So what I am saying here is payment to debenture holders is an obligation of the company. That means whether the company is earning profits or not, they have to pay to the debenture holders. Clear? One thing this. Second thing, payment to debenture holders will be made before anything is paid to shareholders. This I told you in the last lecture also, that debenture holders will be given a preference over the shareholders when we have to make the payments out of profits. Suppose you earned the profits and you have to give dividend to the shareholders and interest to the debenture holders. Now, what will you pay first? First, you will pay interest to the debenture holders, then you will pay dividend to shareholders. Right? These 2 points are very important to remember. Right? This is the base. First, payment to debenture holders is an obligation of a company. Second, payment to debenture holders will be made before anything is paid to shareholders. Clear? Why I have told you these 2 points? Because this is what we are going to use in the further topics. When I will be talking of DRR, DRI, I will be making reference to these points. Right? So remember these 2 very important points. Clear? Now in this lecture we are going to start with a very important topic of redemption of debentures. And I don't know if many of you might be having problems or queries in this topic, right? Now I'll try to go very slow in this topic. What we are going to discuss is creation of debenture redemption reserve, right? In short, we call it as DRR, right? Debenture redemption reserve. Clear? Now, in debenture redemption reserve, we are going to answer three questions. One is, what is DRR? Second is, why we create DRR? And third is, how to create DRR, right? So if you understand these three questions, if you are able to answer these three questions, then that means you have understood debenture redemption reserve, right? Now I'll try to explain, I'll try to answer these three important questions related to DRR. So the first one is, what is DRR? First one is, what is DRR? Now let's try to decode this term. I'll write this in full: debenture redemption reserve. Now I'll do nothing, but I will decode these three words. That's it. That will be the answer to what is DRR. How I am going to decode is, try to understand. Now first I will take this word reserve. You all know what is a reserve. You have studied general reserve, you have studied capital reserve, you have studied workman compensation reserve, you have studied investment fluctuation reserve. So you know what is the very basic definition of reserve. What is it? Money kept out of profits, money kept out of profits to meet any future liabilities, right? Isn't it? This is reserve. What is a reserve? It is any money that is kept separate from the profits to meet any future liabilities. Now, what does these two words mean? Debenture redemption, that means you have to return. Redemption of debentures is return money to public. Now this is what? Returning money to public is what? Your liability, right? This is your liability. And what is reserve? Money kept out of profits to meet any future liabilities. Here you have a liability. Here you have money to meet those liabilities. Now, can you make a definition out of it? Are you getting my point? There is a reserve. Reserve means any money that is being kept out of profits to meet any future liabilities. Now, can you tell me what is the liability in this case? If we talk of debenture redemption, what is the liability in this case? The liability is redemption of debentures, that is the money that we have returned to the, that we have to return to the public. Isn't it? Are you getting my point? What is a reserve? That is money that is kept out of profits to meet any future liabilities. Now, in case of redemption of debentures, what is my liability? My liability is the money that I have to return to the public. Isn't it? On redemption, what I told you, this is the money that I have to return to the public. So that means this reserve is being created for redemption of debentures, and this is known as debenture redemption reserve. The money being kept out of the profits of the company, right? What is DRR? DRR is amount kept out of profits for the purpose of redemption of debentures, right? So are you getting my point? Just decode these two words, debenture redemption and reserve. Reserve is money kept out of profits to meet any future liabilities. What is the liability here? You have to return money to the public on a specified date, at a specified time, at a specified amount, right? So what is debenture redemption reserve? It is the amount that is kept out of profits for the purpose of redemption of debentures. Are you getting my point? So what I have done is I have answered this first question, that what is DRR? What is the meaning of DRR? DRR means the amount that is kept out of profits to meet the future liability. Liability here is the redemption of debentures, right? Now the second point is why we create DRR. This is now an important one here. Why to create DRR, right? Now listen to a short story very carefully, right? I'll explain you this with a short story, right? On 1/4/2016, you have 2000 rupees in your piggy bank. You have done some savings and you have 2000 rupees in your piggy bank, right? Now, on 31st of March 2017, your exams are going to be over and you need a video game, right? You want to buy a video game for rupees 1200. A video game which cost rupees 1200, you want to buy this video game on 31st of March 2017, right? But you don't want to ask your parents for the money, right? You want to be self-dependent. You don't want to ask your parents for this 1200 money for the video game, right? Now, next thing. Every month you get 500 rupees as pocket money, right? Every month you get 500 rupees as pocket money, right? This is what? Your pocket money. Clear? Now, what you will try? You need 1200 rupees to buy a video game. Your first effort will be to save rupees 100 every month so that after 12 months you have 1200 rupees. Are you getting my point? On 1/4/2016, you have 2000 rupees in your piggy bank, right? Every month you are getting 500 rupees as your pocket money from your parents. And on the last day of the financial year, that is 31st of March 2017, your exams are going to be over and you want to buy a video game for rupees 1200. But you don't want to ask that money from your parents. So what you decided, you took a decision that every month I'm getting 500 rupees as the pocket money. Out of those 500 rupees, I will save 100 rupees every month, so that after 12 months I will have 1200, and from that 1200 I will buy a video game. Right? I will buy a video game. Now you might ask, sir, what is the role of this piggy bank? I'll tell you. Now suppose you are not able to accumulate this 1200 in these 12 months. You are not able to accumulate this 1200 rupees in this 12 months. Now what you will have to do then? Suppose after 12 months you could save only 900 rupees. Right? You are in need of 1200 rupees, but you could save only 900 rupees. Now, what will you do? Your next thought will be that why not cover these 300 rupees from my piggy bank? Isn't it? This is what the thought will be. What you will do? You need 1200, but you could save only 900 rupees. What you will do? You will have to take 300 rupees from your piggy bank. Right? So what was the piggy bank balance? 2000. Now 300 you have withdrawn. What is left? 1700. Clear? Now, this was the whole story. Now you will ask why I have told you this story. Why I am telling you this story. Let's see now for the debentures. On 1/4/2016, you issued debentures for 1 lakh rupees. That is 1 lakh rupees. This is loan from public. Right? These debentures are redeemable after 2 years. That is on 31st of March 2018. This is 31st of March 2017. On 1/4/2016, you issued debentures of 1 lakh rupees which are redeemable after 2 years. The period is specified, and which are redeemable at par. The amount is specified. That means you know on 31st of March you need to pay 1 lakh rupees. Right? Here on 1st of April 2016, you know that on 31st of March you will need 1200 rupees. Here you know in case of debentures that on 31st of March 2018 you will need 1 lakh rupees. Clear? Now, during the year 16-17, during this period 16-17, you earned a profit of 50,000 rupees. Okay, I'll say 1,50,000 rupees. Right? You earned a profit of 1,50,000 rupees, and you are very happy that if we are earning the profit at this rate, then we will be able to pay to the debentures next year. But because of some incident in the next year, you earned a loss of 50,000 rupees. This is profit, but here you earned a loss of 50,000 rupees. You could not earn a profit, right? But now what is happening? You need 1 lakh rupees. Here what happened? After 12 months, you could save only 900 rupees. What was your anticipation? Your anticipation was to save 1200 rupees if you save 100 every month. Here your anticipation was we are earning a profit of 1,50,000. Similarly, if we earn the profit at the same rate in the next year, we'll be able to pay 1 lakh. Here your anticipation was if you could accumulate 1200 from your savings, you will have 1200 to pay for the video game. But what happened in the year 17-18? You incurred a loss of 50,000. Now you don't have the profits. Here, what happened? After 12 months, you could accumulate only 900 rupees, whereas you needed 1200 rupees. Here also, you need 1 lakh rupees, but you don't have the profits to pay those 1 lakh rupees. What happened here? You need 1 lakh rupees, but do not have profits to pay 1 lakh. You didn't earn the profits during this period to pay 1 lakh rupees. Similarly, so you are short by 1 lakh. Here you are short by 300 rupees. So how you compensated these 300 rupees? You anyhow wanted to buy that video game which cost 1200. You have 900 out of your savings. Then how you compensated those 300 rupees? You compensated those 300 rupees from your piggy bank. So is the company under obligation to compensate this 1 lakh rupees? This is the point. Yes. Payment to debenture holders is an obligation of a company. That means whether the company is earning profits or not, you have to make payment to debenture holders. So, company is under an obligation to pay rupees 1 lakh to debenture holders. But now the problem here is they haven't earned the profits. How they are going to meet this obligation? You have a shortfall of 1 lakh rupees. Here you have a shortfall of 300 rupees. So you compensated 300 rupees from your piggy bank. Here what the company will do? Company will pay rupees 1 lakh from its piggy bank, and its piggy bank is known as its capital. Right? Pay 1 lakh rupees from its capital. So initially, what was your thought? Initially, you never wanted to break your piggy bank and take money out of it. It was your hard-earned savings, isn't it? You never intended to break the piggy bank, but somehow you couldn't accumulate the money, so you have to break the piggy bank. So are you happy breaking the piggy bank? I don't think so. Even I as a child, when I used to accumulate money in my piggy bank, right, I was never happy if I had to take some money out of that piggy bank, right? So that is the concept. No company is happy to take money out of its capital. Capital is required to run the business. If you have to make a payment from your capital, it is never a good sign for a business. Right? Clear? So can you compare the situation with the story that I told you? Right? There was a shortfall of 300 rupees. Here there was a shortfall of 1 lakh rupees because you didn't earn the profits this year. So now you might ask, sir, where is DRR in all this? Now comes the DRR. To prevent this situation, I told you it is never a good sign for a business to pay such liabilities out of its capital. It is never a good sign. So for this, what the Companies Act says, Companies Act 2013 says that after issue after issue of debentures but before redemption of debentures, if you have profits, then set some money out of such profits as DRR. Why this provision has been inserted in the Companies Act? Because of this situation, right? You earned a profit in this year, but you earned a loss in the next year. You don't have money to pay to the debenture holders, but the company is under an obligation to pay. So how will they pay? They will have to pay out of their pocket. Their pocket means their piggy bank. Their piggy bank means their capital. Clear? So what the Companies Act says? Companies Act says you earned a profit in this year, create a reserve. Create DRR. As soon as you earn profits before the redemption of debentures, right? The Companies Act says create debenture redemption reserve, so that if there is a loss, even then you have some money as the reserves that can be used for redemption of debentures. What was the intention? Here your intention was save 100 rupees every month so that you have 1200 rupees. Here the intention is similar, that save some part from the profits. Profits is the every month the pocket money that you are getting. They say save some part of the profits as the DRR, so that if there is a situation that you are not able to meet the obligation of debenture redemption, you can use this money of DRR. Right? So this is the concept, that why we are creating DRR, to avoid the situation, to avoid making payment out of capital. It is never a good sign for any business to make such payments out of its capital, because capital is the very basis of working of the company. Right? So it is never a good sign to make such payment for the liabilities out of its capital. Therefore, the Companies Act created this provision. They say that after issue of debentures but before redemption of debentures, if you have any profits, set some money out of such profits as a reserve, that is known as debenture redemption reserve. Clear? Right? So we have answered two questions now. One is what is DRR, and the second one is why we create DRR. Now the third one is, now you will ask, what is the money that is to be kept aside from the profits? How we are going to determine the money that is to be set aside out of the profits? That is, the question is how to create DRR. Right? Let's see a picture for this. Creation of debenture redemption reserve. At the time of issue of debentures, amount to be paid at the time of redemption is decided. That we all know. Companies Act 2013 says that after issue of debentures and before redemption of debentures, what they want to say? After 1/4/2016 but before 31st March 2018. Clear? Companies need to transfer a part of profits to a separate reserve created for redemption of debentures known as DRR. So after the issue of debentures and before redemption of debentures, if you have profits, Companies Act says that companies need to transfer a part of profits to a separate reserve created for redemption of debentures, that is known as DRR. And now you might ask, sir, it is an obligation for the company or it is an option for the company? Then my answer is that it is an obligation for the company confined by Companies Act 2013. So every company needs to transfer the amount to DRR. Clear? Now this transfer is to be made before giving dividend to shareholders. Remember this point. Payment to debenture holders will be made before anything is paid to shareholders. Clear? So now, how to create this DRR? What is the amount that is to be transferred to DRR as per Companies Act 2013? Amount to be transferred is equal to minimum 25% of the total face value of the debentures. Right? So this is important. That is why I have colored face value. The first thing is minimum 25% of what? Of the face value. That means if you have issued debenture of rupees 100, right, which is to be redeemed at say 105, so we have to transfer 25% to the DRR. Now 25% will be of 100 or 105. See, the provision says minimum 25% of the total face value. This word is important. So what is the face value here? Face value is 100 rupees, because here 100 plus 5 rupees is the premium. So you have to create minimum 25%. You can create a higher DRR according to your profits, but the provisions of Companies Act says that you have to create a minimum of 25% of the total face value of the debentures. It is to be transferred to DRR. Clear? Now, how to create this DRR? The journal entry for transfer of DRR is surplus in the profit and loss statement account debit to debenture redemption reserve account. Clear? A very simple journal entry. You are creating a reserve. Reserves are shown on the liability side of the balance sheet. So we will credit the reserves. And what is debit? Our profits, our surplus. Clear? Now, the sixth point says, after redemption of debentures, if any amount is left in DRR, that will be transferred to general reserve. What it means? Let's see. Here, you earned a profit of 1,50,000 and on 1,50,000 you created a DRR of 25%. On 1,50,000. So what is the amount of DRR on 1,50,000? 25%. This comes to 37,500. You created DRR. Right? Okay, I'll draw this again. Okay. Now, on 1/4/2016, you issued debentures of 1 lakh rupees, which are redeemable after 2 years, that is on 31st of March 2018. Right? This is 31st of March 17. Now, in this period, you earned a profits of 1,50,000. So, Companies Act says that after issue and before redemption, if you have profits, as soon as you have profits, create the DRR. On these 1,50,000 rupees, you create DRR at the minimum rate of 25%. How much? 37,500. Now next year, what happened? Next year you also earned a profit of 1,50,000 again. And at this point you have to pay 1 lakh rupees. Now when you have profits, why you will use this reserve? You have profits of 1,50,000. You will pay this 1 lakh rupees from this 1,50,000. Simple. Isn't it? You will pay this 1 lakh rupees from your profit of 1,50,000 for that year. So what is the amount of DRR still with you at this point? On this date you will have DRR. You need not use this reserve because you have sufficient profits to meet this liability of 1 lakh rupees, right? So this DRR on this date, when you have redeemed the debentures on this date, whatever the balance is there in DRR, it will be transferred to general reserve. Clear? Now let's take another case. On 1/4/2016, you have issued shares for 1 lakh rupees which are redeemable on 31st of March 2018. Here 31st March 2017. During this period, you earned a profit of 1,50,000 and on this you created a DRR at the rate of 25%, which comes to 37,500. On this date, you know you have an obligation of 1 lakh rupees. Now during this period, you earned a profit of say 80,000. Your obligation is 1 lakh rupees. You have earned profits of 80,000. First, you will use this 80,000 to pay 1 lakh rupees. What is left? 20,000. Now, from where you will pay this 20,000, you will use this reserve created for the purpose of redemption. Why we created this reserve? For the purpose of redemption. Here we have a shortfall of 20,000 rupees. So what you are going to do? You are going to use DRR. Right? Here you pay off 20,000 DRR. Your obligation of 1 lakh is done. And what is left in your DRR? 17,500 rupees. So this will be transferred to general reserve. Clear? This is what this point says. After redemption of debentures, if any amount is left in DRR, that will be transferred to general reserve. Clear, friends? Right? To more small points, DRR is to be created on the non-convertible debentures only. That is, the debentures which cannot be converted into shares or equity shares or preference shares or any other debentures, which are non-convertible, only on that part we are going to create DRR. Right? And the second point says that there are certain companies which have been given exemption by the Companies Act 2013 from creating DRR. That is, these companies, they need not create DRR. Right? What are the companies? All India financial institutions regulated by Reserve Bank of India, other financial institutions regulated by Reserve Bank of India, banking companies and National Housing Bank. Now, why these companies have been exempted? Because these companies have a backing of RBI, that is the Reserve Bank of India, the topmost bank. So even if there is a loss in the companies, that loss will be compensated by RBI, right? Their capitals will not be affected, that will be compensated by RBI because they are being regulated by RBI, right? So that is why these companies have been exempted from creating DRR. This part is very important. Are you clear with this? What is DRR? Why we create DRR? And what is the amount that is to be transferred to DRR? Minimum 25% of the total face value. Remember this word face value, that is very important. Right? And after the redemption of debentures, if anything is left in the DRR, that will be transferred to general reserve. Clear? Right, friends? So I have tried my best to explain you about the DRR. This is very important for you to understand. Right? So if you have any queries, just send me an email at ksjteaching@gmail.com. Right? Now, in the next lecture, what we are going to discuss is, we are going to discuss about the debenture redemption investment, right? Debenture redemption investment. This is what we are going to discuss in the next lecture. So that's all for this lecture, friends. Thank you so much.